Hello everyone, today I'm going to talk about finance and fiscal policy for development based on chapter 15. This chapter actually explains how financial systems work and why they're important for economic development, especially in developing countries. The role of financial system. Financial system plays a vital role in economic development. It has 6 main functions. First, it provides payment services such as checks and cards. Second, it connects savers and investors, meaning that many people who have money and people who need money. Third, it generates information, for example, from stock prices and the bank reports. Fourth, it allocates credit efficiently, sending money to the most productive activities. Fifth, it helps manage risk through insurance and diversification. And the last one, it increases liquidity so people can access more easily. Here we can see the differences between developed and developing countries. In developed countries, financial systems work very well. Banks are well organized. Most people can use these banks. Interest rates are almost the same for everyone, and the central bank is strong and independent. It controls banks and money well. When it comes to developing countries, financial systems have problems. Markets are not organized well. Many people use informal lenders, not banks. Only big companies and the rich people can use easily, and interest rates are different for different people. For example, poor people pay very high interest. When it comes to rich people pay low interest. Yeah, and the central bank is weak. It cannot control everything well. Most developing countries have a dual money market. For its organized market, the organized market includes formal banks. It's offer low interest rates, about 5 to 10%, and all the big companies and rich people can use this. It's regulated by the government. Everything is safe and legal. Next one, unorganized market. It includes money lenders and informal lenders. Interest rates are extremely high, sometimes up to 20%. Per day. For example, if you borrow $100 today, you must pay back $120 tomorrow. So, especially poor people, small farmers, street sellers use this market. Central bank also have 5 main functions. First, it prints money and manages foreign reserves. Second, it provides banking services to the state. Third, they are bankers to the commercial banks and helps in emergencies. And the first, it regulates financial institutions. And the last one, fifth, it controls money supply and interest rates. Currency board and central bank. Currency board is different from a central bank. It fixes the exchange rate. For example, it says $1 equals to 1 peso. It cannot change this. It cannot change this rate, interest rate. It cannot control the money supply. Yeah. When it comes to central bank can change interest rate. It can help it can help other people with problems. It controls money supply in the economy. Yeah, it's better when the company have problems. And most countries use alternatives instead of central banks. Yeah, there are 3 alternatives you can see. One, supranational central banks, where many countries share one bank like West Africa. Second, dollarization, where countries use US dollars, like Panama. And the third one, open economy institutions, where small countries focus on global trade, like Singapore. Here is a historical example. Argentina used currency board from 1991 to 2002, linked to the US dollar. It brought short-term stability, but later failed. The economy failed. You can see that this shows that currency board can be risky. Development banks provide medium and long-term banks for industrial development. They help big companies to build factories. They get funds from government, the World Bank, aid agencies, and the private investors. They are criticized because they only focus on large loans. If you need less than the $20,000 they say no because they often focus on large loans, they often refuse small loans, and therefore do not help small businesses or the poor. Informal finance, ROSCAs. ROSCAs are rotating savings and credit associations. What's actually ROSCA? ROSCA is a group of 20 to 50 people. They meet every week or every month. Everyone gives the same amount of money, and then one person takes it all the money at home, and the next time another person takes it. Yeah, this continues until everyone has taken money once. So there are also good things about ROSCA. No one pay interest rates. You do not need collateral. People almost pays back. That's very good for people actually. They can save money safely. But there are also bad things. The money is not allowed. If someone in the group has a problem, everyone can lose their money. You cannot get a big loan from a ROSCA. For a big project, you need a real bank. You need a real bank, yeah. Microfinance. What is a microfinance? Microfinance means financial services for the poor people. It includes small loans, small saving accounts, and a small insurance. Why it's needed? Actually, poor people have no collateral, and banks find small loans expensive. Without the microfinance, most poor people borrow from money lenders at a very high interest rates. Yeah, microfinance also has types. Microcredit, micro-savings, micro-insurance, and payment services. Microcredit is a small loans to start or grow a business. Micro-saving is small savings accounts for poor people. Micro-insurance is small insurance for health or crops. And when it comes to payment services helps spend or receive money safely. Grameen Bank model. Grameen Bank was founded by Muhammad Yunus in Bangladesh. He won Nobel Peace Prize in 2006. Here you can see the key numbers. About 8.25 million borrowers from this bank. 97% are women. Average loan is $384, and the repayment rate is 98%. This shows amazing result. And how does it work? 5 women are from a group, no collateral needed. They meet every week or every month, as I said before, and loans get bigger over time. And Grameen uses group pressure. Yes, he used a strategy. If one woman doesn't pay on time, and the group cannot borrow again, so this gives a woman a repayment on time, a reason to repayment on time. Here we can see positive implication. Women gain power and respect, children are healthier, families have more food, small businesses grow. But there are also debates, can it help the very poorest? Is 20% interest fair? Can it last without help? Does it truly end poverty? And the research show positive results. Yeah. 18 take more sending per 100 take borrowed, 26% more cows each year, and the borrowers business money triples in 2 years. Microfinance is not only about giving money; it also helps people's lives. One of the most important part is 16 decisions. Borrowers promises improve housing, grow vegetables all the year, keep family small, no child marriage, collective investments, and maintain cleanliness. This shows that microfinances also supports both economic and the social development. Why microfinance focuses on women? Because women tend to spend more children's education, food, health, and women have fewer loan options than the men. Women pay back better, and group pressure, social pressure keep the repayments high. Strong social pressure improve loans performance. Yeah. Here 3 policy debates in microfinance. First, should microfinance receive subsidies to help the poorest or be financially independent? Second, should institutions give only loans or also provide training and health support? And third, should microfinance stay non-profit or become a commercial banks? Each option has disadvantages and advantages. Each country is different, each situation is different, and there is no true answer. Yeah. So that's the end of my presentation. My partner will continue.
Hello everyone, my part is about reforming financial systems, and today we will explore how finance and fiscal policy shape development. And this is the agenda. I mean that we will look at financial repression, liberalization, market failures, stock markets, taxation, state-owned enterprises, privatization, and public administration. At the end, we will see how government and markets must balance each other to serve everyone, not just elite. Financial repression. Financial repression happens when government keep interest rates too low. Banks then lend mostly to big borrowers, while small farmers and shopkeepers are excluded. They often turn to informal lenders who charge very low or very high rates and trapping them into debt, saving the client, investment slows, and inequality grows. Okay, in the 1980s, you can see in this graph, the problem became severe. Inflation was higher than deposit returns, so savers lost money. Loans went unpaid, and governments ran deficit. And people moved money abroad, investment and collapsed, leading to Latin America's lost decade. To fix this, countries tried financial liberalization. It's the interest rate ceiling, how really demand equilibrium, price, and if the markets start clearing interest rates, supply and demand for loans balance. This illustrates how government controls can distort financial markets and harm small investors. Liberalization. Liberalization, promise of liberalization, allowing interest rates to rise to market levels. And I can say that lesson is that liberalization must gradual and supervised. At the same time, some countries like South Korea, Taiwan, and Japan use financial repression strategically, directly credit to industries like manufacturing and exports. This shows there is no signal formula. Success depends on context and governance. Next. Okay, selective intervention success. We can say that, as I said, there is South Korea, Taiwan, and Japan directed credit to strategic industries. And also, this shows that financial repression can work if managed wisely and combined with industrial policy. The government's role in finance. Government regulates banks, protect consumers, encourage competition, and fill gaps with microloans. And in this case, I can say that Bangladesh's microfinance programs gave poor women access to credit, helping them start business and escape poverty. And in some cases, I can say that it really helped women to rise their own businesses and invest their own future. Okay, in this place, I need to talk about stock markets, pros and cons. How stock markets help country to develop, in some cases down. First thing is provide liquidity, easy buying, selling of shares. It really helps. Stock markets can provide liquidity, spread risk, motivate entrepreneurs, and also improve management. But they also bring, volatility, speculation, and destabilizing capital flows. The Asian financial crisis in 1998 showed how quickly capital can destabilize economies. This is the thing that how conditions for stock market success. For stock markets to succeed, three conditions are essential. First thing is macro stability, and second thing is credible policies, and third thing is strong domestic firms. And in this case, we can say that as an example, Poland's gradual reforms created a stable environment for stock markets to grow, while Russia's privatization led to chaos. I mean that there is a strong point that when stock markets are really going to be successful, first thing, they have to take these key elements: stability, credibility, and strong firms. Okay, and when it comes to taxation patterns, this is the main part of fiscal policy, and finance is only one-sided of the story. But when it comes to fiscal policy, taxes and government spending is equally important. Developing countries rely more on fiscal measures because financial markets are weak. Fiscal policy funds education, health, infrastructure, and poverty reduction, and also helps redistribute wealth. But you can see that in some countries also, they are improvement by taxes. For example, in some countries, developing countries, 38% of GDP from taxes, and also developing countries collect just only 18% of them. And there is two taxes: direct taxes and indirect taxes. Difference in reliance. First thing is that developed countries rely on more direct taxes because it's really which is progressive and linked to income and wealth, and also helps people's health in some points. When it comes to developing countries, rely on more indirect taxes, which are easier to collect but often really regressive. Okay, and this is the taxes. There is rich countries collect about, as I said, 38 of GDP in taxes, while developing countries only selected 80%. And developing countries rely heavily on indirect taxes like VAT, value-added taxes, and excise, which hit the poor harder. Properly and corporate taxes are often weak, meaning the wealthy contribute loss. Solution includes strong property taxes, fairer corporate taxation, and efficient indirect taxes that minimize the burden on the poor. The goal is fair, transparent, and sustainable system. Next. Yes, as I said, it is the tax challenge solution, and our goal is mobilize resources for essential services like health, education, and infrastructure, not just the GDP or growth. For example, I can say that Mexico's tax system is highly regressive, and with poor households paying proportionally more. Next one. Okay, state-owned enterprises, SOES. This is the the enterprises are government-owned businesses. Government also state-owned enterprises or COs provide services, stabilize the economy, and create jobs, but COs often suffer from inefficiency and political interference. Reform requires professional management, transparency, and competition. Singapore's Thames holding shows the COs can succeed with global standards. Okay. When it comes to privatization, this is the same meaning, but when it comes to story and experience, the theory is that private firms are more efficient and innovative. Benefits include efficiency, reduced fiscal burden, and more competition, but risks include inequality, job losses, monopoly power. And Chile's rapid privatization led to collapse, while Poland's gradual approach builds stability. The lesson: privatization must be transparent, fair, and carefully paced. And this is the main part of my speech. Finally, none of these policies matter without capable public administration. Skilled managers and strong institutions are the scarce resource in development. Without them, even good policies collapse. A conclusion and lesson for the whole chapter: I can say that public administration collect taxes, manages COs, supervise privatization, regulate markets, and coordinates development projects. South Korea's bureaucracy guided industrial policy, and Singapore's civil service management is effective. The lesson is clear: administration is the backbone of development. And finance and fiscal policy are two sides of the same coin. Finance turns savings into investment, and fiscal policy mobilize and allocate resources. Thanks for your attention. This is the end of my presentation.